All right, well, good morning. Thank you for joining us this morning. I know some of you drove quite a distance to be here, coming up from San Antonio or Corpus, and I know some of you flew quite a ways to be here too. I see some friends from Florida and the other side of the country and from Northern California, so thank you for making the travel arrangements to be here and for sharing your Saturday morning with us. Well, we have a great program for you, so I'd like to run you through the itinerary of today's events. Our first speaker is going to be Arnold, and he's going to talk about the positive trends in the economy, and then he's going to talk about the areas of concern. He's going to talk about investment opportunities and how we invest in an environment like we have today, and where are we in the market today. And his talk is going to go for an hour and 15 minutes. After Arnold's talk, we're going to have a 15-minute break. It'll be our only break between the speakers, so take advantage of that time. Stand up, stretch, another cup of coffee. We'll also have some more refreshments for you out here. And then when we come back, we're going to bring up Senior Portfolio Manager Steve Shipman. Steve's going to talk about the difference between risk and volatility. It's a question we get with the market environment. We see volatility whether in the market or in the portfolio, and so we want to take this opportunity to share with you how we view risk and volatility within the Century investment process. Steve's section is going to take 20 minutes. And then without a break, we're going to bring up our co-chief investment officer, Jim Brilliant. And Jim's going to talk to you about the value gap, that is the difference between price and value. And then he's going to just talk briefly about our valuation process. But he's going to spend most of his time talking about how we try to recognize structural shifts within industries and throughout our economy. And then he's going to give you 3 investment themes that are taking advantage of these structural shifts, and then drill down further still and let you know the companies in our portfolio today that are in these 3 investment themes. And Jim's section is going to take 40 minutes. So now it's time to get on with our program, and we're going to bring up our first speaker, Arnold. Many of you know, Arnold was licensed in the securities business back in 1968, so this is his 45th year in the investment business. And as an acknowledgement to his investment success, Arnold was recently featured in a new book that came out this summer titled The World's 99 Greatest Investors. And in this book, he shares the pages with some of the household names like Warren Buffett or T. Rowe Price, Peter Lynch, John Templeton. So we're all very proud of him for his accomplishments over the past 4 decades to be included in such a great book. Now, as a side note, and I believe it's an important one, and I know that Arnold would want me to mention this as well, and that is that he started in the business 45 years ago, but started Century Management 39 years ago. And our co-chief investment officer, Jim Brilliant, has been with Arnold and by his side for the past 27 years, and Jim has also made great contributions to our long-term track record. So I just want to acknowledge Jim and what he has brought to the table and his contributions to this performance as well. Now, we gave this presentation last week in Houston, 2 weeks ago in Pasadena, California, and we've been working on this for the past 8 weeks, made recent updates now that the September 30 numbers came out on a number of slides. So I know he's very excited to share his thoughts with you this morning. So if you'll all please join me in welcoming my father, Arnold.
Thank all of you for coming here for the 2013 Century Management Client Review. Before I get started, I want to acknowledge our company and our employees who have worked unbelievably hard to get this program going. I don't want to take the time to mention everybody, but I wanted to thank everybody at Century Management. They're all here today and given us tremendous support. This kind of effort takes a lot of dedication on many people who never really get recognized, so I wanted to thank them for it. Also, my wife has not been able to attend these past seminars because of an illness, but I'm proud and happy to see her in the front row this morning, so I want to thank her. As Scott said, the first thing we're going to talk about is the positive trends in this country. And the reason we're going to talk about that is because when you read the newspaper and you hear things on the news, you would think that there's not anything good going on in this country. And there is tremendous, tremendous accomplishments that are going on every day, and it never ceases to amaze me that these are not out in the front pages. So we want to be sure to make you understand some of these positive trends. On the second part, I'm also talking about the areas of concern. And there are many areas of concern, and we're going to talk about them in detail. So I want to give you a balanced approach so you really understand what the positives are, what the negatives are, and how we intend to work through these. There are so many technological breakthroughs that are happening today and are coming in the next 5 to 10 years that it truly looks like there's going to be another industrial revolution. But the three areas we're going to talk about is the low-cost energy fueled by the breakthrough in natural gas fracturing, the manufacture renaissance that is inspired by low-cost energy and technology, and this is just an amazing area. And then we have a very important real estate recovery going, and that's a very important part because that's 22 to 24% of the economy. So we're going to start with the natural gas. I spoke about that last year. Matter of fact, I've been speaking about it for a couple of years. But what is really amazing is here is natural gas and oil drilling. Fracturing has been going on since 1947. So all of this time they've been doing this, but in the last few years there's been such an incredible breakthrough in it that even though it's been going on for 60 or 70 years, they are making incredible breakthroughs. And because of that, because we're getting the cost of natural gas and oil down, major companies from all over the world are establishing plants here, and some of our local companies are increasing their plants because of the low-cost energy. Exxon is building a $10 billion plant, CF Industry a $2 billion, Dow Chemical, multi-billion company. And the strangest of all things, Aramco, which is an Egyptian company that is establishing plants here because they can now get energy cheaper in the United States than in the Middle East. Who would have ever thought that you would have a Middle Eastern company coming over here to establish plants? It's one of the biggest fertilizer companies in the world. Now, just to show you how that breakthrough is coming, I've shown 3 or 4 areas here in what they're doing in the fracturing, and these are the days required to drill a well. Now, if you look at the Haynesville, it used to take 50 days to drill a well. They've got it down to 37 days. In the Eagle Ford area, 38 days used to take, now they've got it down to 20. In the Marcellus, it used to take 28 days, now it takes 17. So when you put all of these things together, they have reduced the time to drill a well by 38%. And this is a technology that's been around for 50 years, and just in the last few years, in the last 3 years, they've increased it by 38%. In addition to that, some of the steps in fracturing, even in the last 6 to 9 months, there's no end to this, they have reduced the time by 50%. This is an extraordinary achievement, and look what it's doing for our production of natural gas and oil. This is North Dakota, where a big drilling effort is going on, and you can see that in 2006, they were only drilling 100,000 barrels a day. In 2013, they're drilling 800,000. So the amount of drilling has gone up 8 times, and since 2011, their production has doubled. This is truly an amazing feat, and it has extraordinary consequences all throughout the economy. Energy affects every industry in the world, and cutting the cost down is just going to be an amazing thing. In addition to that, as I was flying to the LA seminar, there was a big headline in the Wall Street Journal that we now have become the top producer in oil and gas, even over Russia. So we are now the top producer in oil and gas, and by 2017, we're actually going to be exporting natural gas. And the profitability in that is amazing. But let me just give you the bottom line of how it affects you as an individual consumer. There's a company called Global Insights, which does research all over the world, and they've concluded that in 2012, you have reduced your cost in your personal budget by $1,200 after taxes and inflation. So basically, this is just like a tax cut. In 2015, they're projecting that it'll save the average consumer $2,000 a year, and by 2025, up to $3,400. This is an extraordinary achievement, and this is something that the government can't do for you. No matter what they want to do to increase your disposable income, there is nothing that they can do that will give you that kind of benefit. And that is the benefit of the free enterprise system. This is the benefit of technology, and this is going to affect everybody, including manufacturing. Now, let's talk about manufacturing, because this is where the big breakthrough is coming, and we are going to eventually become, and are becoming, the low-cost producer in manufacturing, even beating out China. I'm going to show you how that works. The technological revolution in manufacturing is started by 3D printing, robotics, artificial intelligence, and nanotechnology. There are so many things that these technologies combined can do that it really stretches the imagination, but I'm going to try to give you a couple of them. First of all, through these technologies, they're going to be able to make materials that are lighter than steel and 10 times as strong. So we're actually creating new products and materials through these technologies. They're going to have a little box, no bigger than a sugar cube, that can hold the entire Library of Congress. A device that travels through the human body that is so small that you can swallow it and it goes on to destroy cancer cells. They have a technology now that can spray on solar cells onto a piece of paper, just like you're printing something. You create a solar cell, and it's going to cut the cost of solar energy way down, which is another revolution in itself. And then the ultimate, within the next 10 years, they are taking 3D printers, they're taking your body cells, and they literally are reproducing bones. There's people who have had their jaws replaced by a 3D printer that takes your cells, builds the jawbone right from the cells, so there's no rejection of the body against the foreign tissue, and it's going to be able to replicate bones. The ultimate that they're working on, and they are 1/3 of the way there, is ultimately they're going to be able to print body parts, like a kidney. They are about 5 to 10 years away from actually producing a kidney that is made out of your own tissue and that is put into the body as a replacement without any problems at all. Now, to show you what artificial intelligence will do, you've heard about in 1979 there was a big breakthrough in artificial intelligence because IBM was able to design a computer to beat the world chess champion from Russia. This was an incredible breakthrough for a computer to be able to beat one of the world's greatest chess champions. And they did this through artificial intelligence. But just to show you how far they've come, they have now created a robot with artificial intelligence that has landed a full-blown fighter jet on an airplane, on an aircraft carrier. And this is something that is only used by the greatest pilots that we have to be able to land a plane on an aircraft carrier. And they have done this twice now in July. The other thing that the artificial intelligence was able to do, there's a couple of times where it couldn't land, it aborted the mission, and it landed safely on land. So this is an amazing thing when you think about the fact that artificial intelligence and robotics has advanced so much that they can actually replace fighter pilots. But if artificial intelligence is enough to stretch your imagination, I want to take you one step further. And this is something that I've had a very difficult time getting my arms around because this is a whole new world. It's called molecular manufacturing. And so what it does is it creates manufacturing at a level, at the atomic level. In other words, you can take a couple of atoms, turn it into a molecule, and make body parts. Now, just to give you an idea of how small that world is, if you took the human body, you tried to figure out how many atoms are in the human body. There was a professor, Don Andrews, in the 30s that calculated this for his chemistry class. And he started off by saying, okay, I'm going to use a P to represent an atom, and then I'm going to figure out how many atoms there are in the body. So he said, if you filled the whole United States with atoms, 4 feet deep in P's, you wouldn't get there. So he filled the whole Earth full of P's, 4 feet deep, still didn't do it. Finally, at the final calculation, he came up with 1 octillion atoms, which is 250,000 Earths, 4 feet deep in P's. And that's 1 octillion. So you got 250,000 Earth, 4 feet deep in P's, and that is the level that they're going to be manufacturing on. Now, to give you one more example, if you take a pin, the head of a pin, it's got 5 million atoms across. They now have discovered a way to make glass, are you ready for this? 2 atoms thick. So if the top of a pin is 5 million atoms, this is only 2 atoms, and this is going to go into computers and transistors and everything to do with technology. This is an amazing breakthrough, and all of these things together are going to make the United States the supreme low-cost producer, which is bringing people from all over the world, not only with their talents, but with their corporations. Now, in the last 10 or 15 years, I'm sure that all of you have heard about how many companies went overseas to China to be able to tap their low-cost labor. Matter of fact, many major corporations have plants over there to be able to take advantage of the low cost. They are now coming back to the United States. Dow Chemical, GE, Ford, and Caterpillar to produce 4 major companies that are bringing their plants back into America because of the low-cost gas and because of the technology breakthrough. And the main breakthrough here is in robotics. For example, China is so concerned about this, they have a company over there called Foxconn. They have already produced 20,000 robots, and those robots are producing materials cheaper than their labor force. So now, because of the fact that they can produce it cheaply over there with robotics, they still have the problem of shipping it back and forth overseas, which is a huge cost disadvantage for them. Foxconn is now creating companies in the United States with robotics and is producing goods for the United States, and this is going to create a lot of opportunities for people in this country. Now think about this. If even 5 years ago you could have thought about a Middle Eastern company coming over to America because of low-cost energy and a Chinese company coming over here because we can beat their labor costs. This was even unthinkable 5 or 7 years ago, and here we're seeing it before our very eyes. And just to give you a demonstration of that, we moved out of California for many reasons because of the bureaucracy and many other reasons, which I won't go into detail, but we all know that California is probably the most expensive place because of their welfare system, because of the taxes, and because of the bureaucracy. It's probably the worst place to do business. If you want to put in a low-cost operation, you don't think about going to California. Here is Tesla, an electrical company, a company that makes electric cars, is producing competitively cars in California by using robotics. They have 160 robots that are producing 400 cars a week, and they plan on doubling that by next year. So this is an incredible demonstration of what America has to offer when it comes to these things. Now, with all these wonderful things going on in technology and in these industries, you would say, well, that's the place to invest. Well, I would say not usually, and I'm going to show you why. We will invest in any of these companies, and we have in the past, but the problem with these companies are they're started by young entrepreneurs. They're not proven in their ability to manage a company, even though they have the right technology, and there's a lot of risk in these companies. You never know which one is going to make it and which one isn't. In addition to that, these companies sell at very high multiples because they have all the growth ahead of them. So you're paying extraordinary prices for unproven companies with one thing going to technology, but that's not enough to make it. And I'm going to show you that. Guess what the great technology breakthrough were in the turn of the centuries? It was the automobile. Everybody was using horse and buggy and manual labor, and here we had the car coming. This was the technological breakthrough of the turn of the century. They produced over 1,800 cars. 1,800 individual car companies were produced. How would you ever know which one was going to survive out of the 3 or 4 that survived? You all heard about Hudson, Studebaker, Packard, Nash Rambler. I even owned a Nash Rambler at one time. Those companies are not around anymore, and there's only 3 or 4 companies left. So it would have been extremely difficult, even though you saw it coming, to try to pick the company that was going to be the winner. So how do you make money on this knowledge? You make money at the turn of the century. You could have made a lot of money by investing in steel, by investing in aluminum, by investing in electric parts, rubber for tires, and other supply, without knowing or caring which company was going to be successful, because these products are used in all automobiles. So if you invest in the picks and shovels instead of going mining, you're going to make money no matter who is successful. So our strategy is to follow these technologies, to look at the companies that are going to benefit from it, and to buy those proven companies that benefit from the technology, not the technology themselves. Let me give you an example. At the 1800s, as you all know, there was a big gold rush. Everybody went mining for gold. Levi Strauss made their fortune, made more money selling jeans to miners than anybody did mining gold. And that's our theory. When there's a gold rush, you invest in the picks and shovels, and you make a lot of money, and you don't have to guess who's going to be the top one in the area. Now, you've heard me talk a lot about 3D systems, especially last year. And for those of you who haven't heard the story, I just want to repeat it because this is an extraordinary feat that's been going on. Now, 3D printing actually got started about 20 or 30 years ago, but just like the breakthrough in technology and fracturing, it's only taken off in the last 5 to 7 years. And what it is called, it's additive printing. So what you do is you get a blueprint, you put it in a machine just like a printer, and then you have the raw material come into the machine and it prints it layer by layer. It doesn't cut something out of wood or steel, it literally builds it from the ground up. And by building it from the ground up, you get an accuracy that you could not get under any other process. The advantages to 3D printing are so immense that it's hard to figure out just what it's going to be. It's about a $2 billion industry, but let me give you the main benefits of 3D printing. It costs, the savings by using 3D printings are as high as 70%. You have a quick turnaround, you have less waste, almost 60% less waste, because instead of cutting something out of a raw material, you're building it from the ground up, so there is no waste. You have new shapes and designs and figures that were not possible under any other process, and you have new business models for entrepreneurs. The amount of things that they can do with 3D printing is truly amazing, and GE is already using some of the 3D printing to build some of their engines for their electrical divisions. Now let's take a look at 3D systems, because there's a company called 3D Systems who's the pioneer in this, and let's take a look at whether this would be a good idea to invest in the company. Now, first of all, we as value investors, the first thing we look at, no matter how great something is how cheap is it? Can we make money? Is there a low-risk situation? That's the most important thing. We can think of a lot of things that are going to do great, but we don't know how much risk there is on the downside. Now, just to give you an example, 3D printing, and I'm going to use a very common metric that you use in this business. We use many different metrics, but let's just use one to make it real simple. And that is what we call a price to sales. In other words, a company has $100 million in sales, it probably sells for $100 million, one-time sales. Century Management's portfolio, every stock in your portfolio combined is selling at 0.83 of sales. That means less than one-time sales. The Russell 3000, which is big and small companies, sells at about 1.15 times sales. The S&P, which has 500 of the largest companies in the United States, sells at 1.45 times sales. 3D printing is selling at 11 times sales. So you get the idea that this company is very highly priced relative to any other measure you want to use. Well, why is it selling that high? Because of the growth potential. People are looking at the growth and saying, wow, this is going to be a big thing. But that stock is already probably discounting 5 or 10 years' growth. And if it doesn't happen, look out below. Now, let me give you an example. Every technology company, when it starts, sells at high multiples of sales. Apple sold at one time at 7.4 times sales. Right now, it's selling at 2.6 times sales. Dell sold at 8 times sales. It's selling at 0.4 of sales. Intel sold at 16 times sales. It's selling at 2.2. Cisco sold at 39 times sales and is selling at 2.6. And Amazon sold at 197 times sales, and it sells at 2.2 times sales. So the point I'm trying to make is whenever these companies mature, no matter what the multiples are on the top, they're going to go down to about 2 times sales. Now, the sales of 3D System is $4 per share. If, God forbid, something happened to that company and it sold at 2.4 times sales or 2 times sales, it'd be selling at $8. Even if it grew and doubled for 3 years, and the sales were $8 a share, and it sold down and sells at 2 times sales, it'd be $16. The stock is at $56 today, so from $56 down to 8 or 16, that's a long ways down. That's far too much risk than we would ever want to take. Now, let's assume that everything turns out right for 3D printing. So I made a projection that for the next 10 years, they're going to grow at 25% a year. They have never even grown that much since they began, but I'm just going to give it the benefit of the doubt so you get the idea. So we're going to grow it out for 10 years, 25% a year. Their sales would go from $4 to $37. But if at that time it sold at 2 times sales, the stock would go to $74. Well, if it went to $74 from $56, that's about a 3% return over 10 years. That is not something worthwhile or even to reach for. But to think that if something would go wrong, that it would go down to $16 or $20 a share, you've got a lot of downside and very little upside. And as Jim will show you later on in the session, we like to get a little bit on the downside and a lot on the upside. This ratio is completely reversed, and therefore, we would not consider buying it at these particular price. Just to give you a little insight, the insiders are selling 25% of their stock. So you kind of think about if all these great things are going to happen, why are the insiders selling it? Because they understand, like we do, that eventually something is going to slow down. Stock may not be that high. But just to give you an idea, when I first got in this business, I was very enthusiastic about this one stock. I used to talk to the president all the time. He told me all the glorious things they were doing. Everybody was happy. We were making money. And one day I woke up, went to the office, and there's an article saying that the insider's selling a big block of stock. I thought, God, why would he be selling this stock after he told me how great this thing is? So I called him up and I said, hey, I just noticed that you guys are selling a lot of stock. Why are you doing that if it's such a great company? And he says, well, I've got a son going to college. So I thought, oh, okay. So I went back to my desk and I figured 5 million shares at $20 a share, that's $100 million. That is one hell of a college. Can you imagine how smart this guy's going to be when he graduates from that college? So the point I'm making is when insiders are selling, that is usually not a good sign. It doesn't mean that the stock's going to go down, but it does mean that maybe the insiders would prefer to diversify, as the other words they use is, I'm just diversifying my holding. Well, I don't like to diversify my holding if I've got a big winner. So if this company was a big winner, I don't think they'd be diversifying. So you're going to learn a lot about these new technologies. You're going to read articles about it, and you're going to want to be tempted to buy these stocks. And I'm cautioning you don't buy the stocks unless they're at multiples that are reasonable, because there's many ways that we can make money by investing in things that are related to that. Now, let me just remind you of something that I shouldn't have to remind you of, but let me bring it up to situation in the tech bubble. Do you remember in the tech bubble where the market, the internet was coming out and tech stocks were going at 50 and 100 times? They weren't making any money and nobody cared because you were just going to make a lot of money. And they made proclamations for these companies that actually came true. Everything they said about the internet did come true. The problem is, if you look at the NASDAQ, which was all technology stocks, it reached 5,000 at the peak. It came down, and here it is 14 years later, and it's still down 25%. What happened? The technology delivered. But the problem was that these stocks were discounting 20 years of growth. And if something happens in between that, look out below. So remember, no matter how exciting the technology is, and we're going to be talking a lot about that, don't get caught up in the idea of paying ridiculous multiples for these stocks, because you could be sitting 10 years from now and still not have a profit. So we're very excited about the technology. We are looking at the areas which are going to benefit. Jim is going to give you the exact areas that we're investing in. We're very excited about it, but we're not excited about paying high prices for high multiple stocks. Now, let's move into the next area, which we're very excited about. We've been talking about this for 3 years, but it finally came about, and we did very well in the stocks. We bought a lot of building stocks and stocks that related to the building. They've all done very well. Some of them we've already sold, but we're in a couple of other areas. This is an area where we feel there's going to be a lot of potential. And if you look at the first chart, it shows that real estate still has a ways to go. This is called the affordability index. And you want to look at this index when you're looking at real estate, because it tells you the potential. In other words, what is going to make real estate go up higher? If more and more people can afford to buy homes. If you were in a position where people couldn't afford to buy homes, then obviously the real estate market's not going to go up. This is the affordability index, and it was way up on a 35 to 40-year high. It's come down, but you can see that it is still at a 30-year high. So this is a very good sign that despite the fact that real estate's going up and there's a broad recovery going, there's still a lot of potential in there. And so that bodes well for the future of the real estate market, and for those of you who own homes, and for those of you who have opportunity to invest in real estate, I would strongly recommend, if it was bought at the right price, that is a place to be. It's one of the few asset classes that are still great values. And here is the Case-Shiller Index. I'm showing this to give you a perspective of where real estate was at the top of the market in 2006. You can see how it's bubbled along on the bottom here. And now it's got a very strong uptrend, and so it's got quite a ways to go. Well, we've covered some of the most exciting things in the economy: the low-cost energy fueled by breakthrough in natural gas fracturing, manufacturing renaissance, and the real estate recovery. These trends are very good news, but our strategy is this. We want to study to see what's going on. We want to avoid those industries and stocks that are going to get hit by this technology, because as good as this is, if you're on the right side of the track, it can be devastating if you're in the wrong side. So we're studying to see which industry are going to benefit from it and which industries are going to be obsolete or not be as competitive. So we want to look at both sides, and then we want to invest in those industries that benefit, because the reduced cost is going to increase production, higher profits, and have a great ability to grow with a lot less risk. So those are the strategies that we're going to use, and Jim is going to give you all the details on how we're going to do it later on in the session. Now let's look at some of the things that are concerning, and they are very much of a concern, and they're long-term problems. The first one is the unemployment problem. And you can see that this is the headline unemployment. Whenever they talk about an unemployment figure, this is the chart that they usually give you. Now, if you look at this chart, it actually looks like it's getting better. I mean, the unemployment was down to 10%. It's now at 7.2%. So that looks like a positive trend. Well, how do you reconcile that with the fact that there's so many people out of a job and so many people working part-time and they can't get a job? The way you reconcile it is this is not the whole story. This is just a headline story. Let me give you the whole story. The whole story you can see better in this next chart. And this shows you that the unemployment level is the highest in 30 years. This is a chart that measures the number of people that are available for work and the people that are working. Now, you can't get anything simpler than that. You got the number of people available and the number of people working, and that is the lowest in 30 years. And that is the problem today, and I'm going to show you how to reconcile those charts. Here is what we call the U6 unemployment. And that's what we spend our time thinking about more than any of the other two charts, because what this chart shows you is the math. And the math is there's 11 million people looking for a job, 11,255,000 to be exact. But there are 7,926,000 people who are working part-time because they can't get a full-time job. And so if you add those people up, and then you've got 3,219,000 people who are so discouraged from looking at a job, they've quit looking. What's really disturbing, in the last month, 500,000 more people were added to the discouraged roll. It went from 2.7 to 3.2. So that is a very big problem. And if you add it all up, you got 22,400,000 people out of work or underutilized, as opposed to 11 million. And the unemployment rate is not 7.2, it is 13.1. And that is one of the highest numbers we've had in 30 to 40 years. And until that changes, you're not going to have a lot of growth in the economy, as I'm going to show you later. Now, the main theme that I want to emphasize throughout this seminar is that the real key to all the problems is jobs. And I'm going to show you later on how crucial that is. Because if we don't grow the economy and we don't create jobs, we don't have consumers, and consumers are 70% of the economy. So if you can fix something that's 70% of the economy, you've solved your problems, haven't you? So let's take a look at the job creation. That's the one thing every month I'm most concerned about. And in the last year, we've created 180,000 jobs per month. But in the last 3 months, it's dropped down to about 148,000. The last month, it was 145,000. Let me show you how long it would take to fix the unemployment problem at this rate. Let's say that we're creating 185,000 jobs a month. That's the figure that's been last year. It's slowing down, but let's just use the best number we got. There are 70,000 new people coming into the job market every month. So we are net creating 115,000 jobs. If you do that times 12, you got 1,385,000 jobs that we are creating. In order to get the unemployment down to normal levels, I figured it would take about 8,720,000 jobs. So in order to get that unemployment down to the normal levels where we have a strong economy, it take 8 million. At the current rate of 1.3 million, it's going to take us 6.3 years to fill that gap. If we grow at 145,000, which it did the last 3 months, at this rate, it would take 9.7 years. So this is a very long-term problem that needs to be solved by increased manufacturing, which hopefully is coming, and greater jobs. Now, there is one good sign going. In a dismal picture, there's some very positive signs, and this has just been recently in the last month. Take a look at this. This is the small business hiring plan. Now, the reason this is so important is companies that are less than 500 employees per company are the fastest growing companies. They're the ones that add the most jobs. They add between 60 to 80% of the new jobs in this country. So that's where the action is. And there's a survey by the Association of Small Businessmen, and they poll small business people all over the country, and they say, how many people do you plan on hiring? Well, this indicator has gone up, and it's up 9% this last month. It's up a little higher last month, but it's still up pretty good. So this is a very positive sign that if we can get the jobs hiring going and increase that production, it'll make a huge difference. Now, let me just say to you that while we're creating 145,000 to 180,000 jobs a year, in a good, strong economy, from our economic recovery as we have, we should be able to do 250 to 300,000 jobs a month. And if we do, the figures of solving this problem goes from 6.3 or 9.7 at the worst to 3.2 years. So once we get the economy going and once these jobs start to come through, we can solve this problem in 3 years or less. And that is why the job picture is so important to everything we do. So that is one of the concerns. I want you to write this down because that's going to be with us until the job figures changes. We watch this very closely every month, and we'll keep you posted on that. The next major area of concern, which has been in the headlines all the time, and for good reason, is the federal debt. And this is my favorite quote, and this is why I include it in every conversation or seminar that I teach, because this is one of the major problems confronting everybody as an American. Doesn't matter what party you're in, this affects everybody in America. Truth is not only violated by falsehood, it may be equally outraged by silence. The decline of all great nations started with too much debt, including the great Roman Empire, right to the present countries in Greece, Italy, Spain, and Portugal. You can't even believe what's going on in these countries. I'm going to show you that a little bit later. But that is one of the problems. Now look what happened to this country. 5 years ago, the debt was $9 trillion. It's now $17 trillion. 10 years ago, it was $6.8 trillion. It took us 200 years to get to $6 trillion in debt. 200 years. And it only took 10 years to take it from $6 trillion to $17 trillion. Now think about that. It doesn't matter what party you're involved in. This is something that is clearly unsustainable. And one of the things that it's not showing right now is the interest rates are so low, so the interest on the debt is only $241 billion. It's only a few percent. But if interest rates go up, 1% more adds $160 to $200 billion to the debt. Our debt service could skyrocket, interest rates would go high, and we've had a lot of problems. So this is something that has to be taken care of, and it has to be addressed, and I'm going to show you a couple of ways that we could work our way out of this. Now, just to give you some relativity, you say, well, we have a $16.5 trillion economy, you have $16 trillion debt. What does that mean? Well, we now have as much debt as we have a GDP, total economic environment. We have 100% debt. Well, what does that mean? Usually when a country gets to 60 to 80% debt, that's a warning sign that it's gone too far. We're at 100%. So I made a study of 31 nations that filed bankruptcy or had to reorganize themselves under bankruptcy codes. 31 countries in the last 30 years. The average GDP was 69%. In other words, 70% was about as far as you can go. We're at 100%. Only 5 of those countries had a GDP, debt to GDP, higher than 100%. So you know that 100% is pushing the limit when only 5 countries got away with that, and the other ones were even at 69 or 70%. So this is a major concern. Now let me tell you what happens when a country goes too far in debt, and then people won't accept the debt, and you have to restructure, and you go through all the things that Greece, Portugal, and Spain have gone through. The first thing you get is high interest rates, which raises the cost of everything. 25% unemployment in these countries across the board. And among the youth, it's 40 to 50%. So you can see that, as you've been reading in the paper, there have been riots and strikes and all kinds of civil disobedience because of what's happening to the public. Now, let me tell you what happened to the public. Their pensions, which were promised to them by the government, were cut 50 to 70%. So this would be like Social Security being cut 50 to 70%. I'm not projecting that that's going to happen, but that's what happened in these countries. They eliminated all kinds of services. There is just chaos in these countries, and no matter how much of a bailout they get, Greece is about ready for another bailout. And this just goes on and on. The suicide rate in Greece was the lowest in the world. It's now the highest. So if a nation doesn't meet their demands to get things in line, it's going to work out one way or another. And so these are the kind of situations you have. Now let's look at the main problem, which is the U.S. unfunded liabilities. You know, all of these government programs are great. They all help a lot of people, and we should have them. The question that I've always asked, who's going to pay for these things? How are we going to pay for all the things that the government wants to do for us? And I'm all for them. I'm not against them. I know that Social Security's helped a lot of people, Medicaid, Medicare, all of them, Obamacare. But the question is, how do we pay for it? There's no argument about the fact that we should have them. The question is, how do we pay for it? Now, take a look at this. Sometimes the best intentions produce the worst results. And there's nothing that will show that better than these statistics. These are all good intentions. Look at the results. In 2003, our unfunded liabilities, which is Social Security, Medicare, Medicaid, all the government programs, had a $39 trillion unfunded liability. That means we're going to have to come up with $39 trillion. I was so concerned about that in 2004 that I wrote an 88-page newsletter. 88 pages telling you about all these things, and I thought, it just can't go on anymore. How can we fund $39 trillion of unfunded liabilities? Well, in 2008, it went up to 65, and today it's 2013, it's 84 trillion, and I'm still scratching my head saying, I can't believe that we run up this kind of debt, and we're still going. But somewhere along the line, something has to be done. Now, a lot of people feel that the way to solve this problem is to raise taxes, and especially on the wealthy. Why shouldn't the wealthy pay more? They're living so well, they've got all this money, and all these people are struggling with their medical insurance and so forth. Well, let's take a look at this and see if that's really realistic. Take a look at the 2000 tax returns. This is the top 1%, 5, 10, and 25%. Now, if you look at the top 1%, they make $1.5 trillion. They pay $354 billion in taxes, which is 37% of the taxes. So the top 1% pays 37% of all the taxes. Now, let's just, for sake of imagination, because you could never get away with it, you can raise them a little bit, but you're not going to raise them double. Let's just double their taxes. Let's just say, by golly, it's time to get our debts down to pay all these wonderful programs. Let's raise them $354 billion. If you took the top 1% and you doubled their taxes, and you took that $354 billion and paid it to the unfunded liabilities, it'd take you 200 years to pay it off. So obviously, that's going to not solve the problem because you probably can't even double their taxes. But if you could, it still would take 200 years. So on the right-hand column, I say, well, let's look at the corporations. They're so wealthy. They've got so much cash. They're making so much money. They're making $2 trillion, and they're paying $418 billion in taxes. Let's just double the taxes on the corporation. So you double the tax on the corporation, you got $418 billion. It takes you 237 years to pay it off. So obviously, raising taxes is not going to solve the problem. It's a Band-Aid. It doesn't do anything, but here's the worst thing about raising taxes, and nobody talks about that. And this is what we call Hauser's Law. There was a very good economist, money manager, who kind of put this idea all together. And it goes to show you what happens if you raise taxes. Now, believe it or not, after the war, the top marginal tax rate, that's the top rate that you pay on the top money you make, was almost 84 to 85%. It almost got as high as 90 at one time. and look at the federal government on the bottom. That's their revenue. You notice when the taxes were into 90%, they didn't make any more money on the revenue they had. They made 20%. As the taxes has gone down, they're still only making 19%. So whether you raise the taxes to 90% at the top bracket or leave it where they are, the government is not going to make more than 19 to 20%. What is the reason for that? How could they not make more money if they're getting more in taxes? The reason is all this ingenuity, all of this brain power that creates the Apple and the Microsoft and the Nikes and all these Amazons, all these great companies, that kind of energy goes into saving money on taxes. So instead of building companies, they build tax shelters. They devise companies that lose money so they get tax breaks. They take this creativity and they bring it overseas and they invest overseas. They put it in tax shelters and foreign banks. They rush all over the world to try to cut their tax bracket down so they don't have to pay that much in taxes. And in so doing it, the productivity of this country goes down, we produce less goods, and even though the government gets a higher share of the profits, they make less money because their revenue goes down. So raising taxes, as you can see, even if you took the top 5%, is not going to solve the problem. Well, if that's the situation, what could solve the problem? What do we do? What is the best policy for this government to do? Well, let's take a look at Social Security. If you look at Social Security, it is based on the fact that the government runs out the statistics for 75 years, and then they present value it back, and so they say over the next 75 years we're going to collect this much, the economy is going to grow this much, we're going to collect, and we have this much in liability. And it's based on 2.2% growth in the economy. That is the good news. At least one thing that the actuaries did is they used a very conservative growth rate. So if we grow faster than that, we can do a lot better. But let me give you just one caveat about economic projections. And I learned this from President Nixon. He wasn't the most admired president I had, but he had a couple of great insight, and this was one of them. I have found that my economic advisors are not always right, but they are always sure. So the point is that when you look at economic projections by the government, you can almost count on the fact that they're not going to come in, and they're always going to be more rather than less. Let me give you an example. In 1963, they started off Medicare, and they projected that by 1990, the Medicare cost would be $9 billion. So in 1963, 30 years ahead, they said it'd be about $9 billion. The actual cost at that time was $67 billion. So it went from $9 billion to $67 billion. And this has been true of all of these different programs. But let me give you one thing that is a little bit encouraging. In 2003, there was a report out that said that Social Security projections that they would be out of money by 2037. So that was the projection in 2003. 5 years later, the projection showed that it was 10 years longer. So, while it may not be the final solution, the real answer to this problem in Social Security, Medicare, and all of these government programs is that if you want to continue with these programs, you have to cut the costs now in the programs, and then you have to grow the economy. And the way you grow the economy is by giving entrepreneurs incentive to build businesses, to create products, and to create jobs. And that pushes everything forward. And if we were to do that, we would definitely have a chance of working our way out. And it's really our only hope. Let's go into the next section, which is the consumer debt. And here is some very good news. Now, while the government is continuing to pile up the debt, the consumer is actually liquidating their debt. They are saving more money. They're paying off their debt. Some of these loans have gotten foreclosed on. You've had cars repossessed. There's been a lot of bankruptcy and so forth. But the bottom line of it is that the free enterprise system is working in that the consumer is learning their lesson. They're spending their money more wisely. And because of that, they've cut the debt to GDP by 97% to 80%. And that is an extraordinary achievement. We're not there at the level it should be, but we're way ahead of the game. And so this is a very positive trend. And what is the lesson of that? When people are accountable, when they lose their home if they don't pay their mortgage, when they lose their car if they don't pay their debt on their car, then they learn the lesson, and then they do not get more credit because the credit agencies aren't going to extend it. What happens with the government? They run up more debt, they just raise the debt ceiling, and we just go on again. So unless they get together and not only raise the debt ceiling, but figure out a way to cut the budget, these problems are going to continue. Now, the next problem we're going to talk about, which is a very big problem into the future, and that is the Federal Reserve policy. Because of the recession, the government and the Federal Reserve has created a tremendous increase in their balance sheet. Some people call that printing money. I wouldn't exactly call it printing money because the money is not in circulation. As I'm going to show you, the money is actually going into the banks. But if this money was going into the economy, then of course you would be having high inflation, and that's what everybody's worried about. But if you can see, this is the expansion of the money supply, and this is unprecedented in the 100-year history of the Federal Reserve. This is just extraordinary. Now, if you look at the next chart, you can see that as high as that curve is, that money is not going into the economy, that money is going into the banks. So the banks are getting a free ride. They're putting the money in, they're creating the money and putting it in the bank. The banks landed out at 2.5% to 3%, and they are making real good money, and they don't have to lend money to the consumer because they're making this without taking any risk. And a bank would rather have a risk-free loan than one with a little bit higher than loans. So what is going to solve this problem? As long as this money stays in the bank, you're not going to have high rates of inflation. But the minute it starts to circulate, you can have very high rates of inflation. Now, the rate of inflation can come up to you like a thief into the night. In the 70s, I'm going to give you an example. The Fed did the same thing, but they didn't take the money out. There's two things that the Fed can do. They can create this liquidity and get the economy going, and then they can slowly pull it out, as I'm going to show you Japan did, and then you don't have this high rate of inflation. But if you leave it in there, you're going to have high inflation. And this is a chart what happened in the 70s when I started Century Management in 1974. The inflation rate was running at 2.7%. And in a matter of 2 years, it went from 2.7 to 12. It was going up every month, and the stock market went down 45% in the big caps and 75% in the small cap. So this was one of the worst bear market since the Great Depression. And while I was in that field, I thought to myself, you know, things can't get much worse, and stocks are so cheap at 5 to 8 times earnings. So I decided to start Century Management because I thought it was a great opportunity to be able to buy these stocks very cheap, and it turned out to be correct. But the feeling at that time was like the world is going to come to an end. I figured if the world comes to an end, it doesn't matter, and if it doesn't come to an end, I'm going to make a lot of money. So that's the way to think about the value system. So what we have to do is we have to recognize that if the government is not going to pull this money back out, we're going to have high inflation, and we're going to have to deal with this. If they pull it out in time, then we can avoid this inflation. That's exactly what Japan did. Take a look at the chart on Japan. Japan had this huge run-up in bank reserves in the year 2000, and then a couple of years later, they pulled it right back out, and they avoided the entire rate of inflation. There's only one problem with that system, is that when they pulled the money out, the economy slowed down, and in the last 5 years, they've had a minus 1.6% growth. The last 10 years, it's only been 0.56, and in the last 15 years, they've had 0 growth. So what this did is they ran it up, they saved the inflation, but they had a very low growth rate, and look what happened to their stock market. It's still down 63% from the '89 peak, and it's taken 24 years and it still hasn't recovered. So if we're going to pull the money out, it's got to be done in a very slow method used, because if it isn't done properly, we could have a very slow growth. We may not have a lot of inflation, but have a slow growth, and it would be difficult to grow the economy. So to summarize it, we've got two approaches. If you leave it in, we have to worry about inflation. If they pull it out too fast, we could have recessions or slow growth, and that is the crisis right now that the Federal Reserve finds themselves in, and there's a lot of people feel that it can be done. I've talked to people who've spent 20 years on the Federal Reserve. They feel we could pull this money out gradually, but if they overstay, we're going to have a lot more inflation than we've ever had in the past. Now look at what the Japanese are doing, and this is a real concern. Here is a nation whose culture did not believe in printing money, and now they're doing it more than anybody else because they have had a lost decade. They want to make up for it, and they are creating this kind of money printing, and that's not only going on in Japan, that's going all over the world and in the United States. So there is going to be a day of reckoning for some of this. We really have to be prepared for this, because if it pulls back too fast, we've got some serious problems. Now, let's talk about inflation. A lot of people say, well, if the government created all this money, how come we haven't had inflation? So the CPI says that we've only had inflation of 2.4%. How many people have had more than 2.4% of inflation in the audience here? Can you raise your hand? Look at your hands, right? Don't be shy. Okay, so you can look around the room and see that most people have experienced a lot more inflation than 2.4%. So what is the problem? Is the CPI wrong, or what's going on? Well, you can question the CPI, as I have for many years, and I watch it very closely, but after doing a lot of study, I don't think the CPI is wrong a lot. It may be understating it, but what it happens is over the long run, it sort of catches up, but in the short run, it could understate it by 2% or more, and I think that's what's happened in the last few years. Now, fortunately, there's a way of checking that. There is an institute called the American Institute of Economic Research, and they have an independent, non-government agency that follows all the costs, and it's called the Everyday Pricing Index, and you can see it on the chart. That's the top figure, and you can see that the CPI is here, and the Everyday Pricing Index is there, so you can see that that is a lot more inflation than the CPI shows. Now, one of the reasons is the way they weigh it. In the EPI, the Everyday Pricing Index, they don't show any cost for housing because they're only doing everyday pricing, something that you spend at the grocery store, that you buy your clothes, things that you do on an everyday basis. The long-term trends of housing and car purchases are over a longer period, and so they kind of move that aside. The CPI does all of these things, and the housing has been very depressed for the last 5 or 6 years, so that has dragged the CPI down. But once the housing starts to move and it gets filtered through the CPI, it's going to play catch-up, and I think you're going to see a CPI that's much higher. Now let's take a look at the real inflation. The CPI says that for the last 5 years, we've only had 1.3, and in the last 10 years, 2.4. If you look at the EPI, it says 0.7 over the last 5 years, but 0.4 over the last 10 years. If you take commodities, which are a good way to look at inflation because these are all the raw materials, they have gone up 6.4%. And if you look at agriculture products, they've gone up 5.9%. So if I take that as an average, I think the average inflation rate in the last 10 years is closer to 4.68% than it is than the 2.4%. And I think the CPI is understating it. If you look at gold, it's up 14%, oil and gas is up 13%, hospital service up 5.9%. The only things that are down is the housing, which is 30% of the index, and apparel and auto. So most of the things are much higher except those two factors. And I think that the reason that the CPI is so lagging is because housing is 32% of the index, and then there's another 10% that is due to the fuel and things that go into housing. So basically, housing is almost 41% of the CPI index, and when that starts to move up, you're going to see much higher inflation. So when you look at all these problems, and you look at the good things that are going on, and you look at the problems that we have to face, you say, how do you invest in this kind of an environment? What do we do? Well, I want to remind you that we've always had problems in this country, and since I've been in business the last 40 to 45 years, we've had 3 terrorist attacks, 27 military campaigns, 5 Republican presidents, 3 Democratic presidents, 6 recessions, 6 worldwide currency problems, 20 major companies going bankrupt, 35 notable natural disaster, oil prices going from 3 to 145 and so forth. So as you can see, this country has always had problems, and the way you invest in that is to invest in assets that benefit from the growth of the economy, which eventually comes. And you can see on this chart here, I've listed all of the different stocks and bonds and all of the different asset classes, and you can see that during this whole period, stocks have gone up 11%. Our company has made 14% over the long term, 8.8% in long-term U.S. Treasury, 7% in business real estate, and down the line. So if you look at what to invest in, you can see that if you buy common stocks at the right price, it is the best investment you could make compared to all other asset classes, even though those asset classes have done good and can even do better if you buy them at the right time. So let's review the asset classes and see where we are. If you look at the long-term bonds, the bond rate has gone down to almost a 60 to 70-year low. So that means that over the long run, if we have more inflation and higher interest rates, those bonds are all going to go down. I can't think of any asset class over the next 10 years that is going to do worse than bonds. And it is for this reason that in our bond funds and in our bond portfolios, we're all in short-term paper so that if the bond market goes down, we'll be able to roll that cash into higher yielding securities, and it'll be also short-term until we really get down to the place it should be. Now, let me give you some idea of where bond rates are going to go. Usually, bonds sell at 3% over the inflation rate. So if you got an inflation rate of 3%, then your bonds are going to sell about 6%. If you have an inflation rate of 4%, you're going to have bonds at 7 to 9%. And if you have an inflation rate of 7 to 10%, you're going to have bonds at 10 or 13%. Now, I can't predict what it's going to be, but I can tell you the inflation and the interest rates are going to be much higher in the next 10 years. I'm not so sure about the next 2 or 3 years because there's still a lot of slack in the economy, so they probably could be okay for the next couple of years. But I don't want to take that chance in being long-term unless it's just certain portfolios because of the fact that there's so much risk on the downside over the long run. So over the long run, I predict that if you're holding long-term bonds over the next 10 to 12 years, there could be losses as high as 40 to 50%. So that's not an area where we want to be, especially on the long side. We do want to be in the shorter-term bonds that give us the liquidity and give us a return, and as the rates go up, we will reinvest them at higher rates. Now, the next asset class I want to talk about is cash, and many people ask us about this because the market's going up, and we're in about 23% cash, and the reason is that when we buy at the buy point, when it gets at the sell point, we sell it irrespective of whether the market's going up or not. That is the discipline, and if we stick to this discipline, we'll always be able to make good returns irrespective of what's happened. And I showed you all of the things that happened in the past, and we've always been able to make money over the long term because we use the discipline of buying it right, having the reward to risk in our favor. Now, you say, well, if we're sitting 23% in cash and we're not making any money in the cash, we're not making any money. Well, that's not the way to look at it. The way I look at it and the way we look at it at Century Management is if we're looking at a stock I started to buy one stock. I don't want to mention it because we're not entirely through with the purchase, and I want everybody to be able to get a fair price. But we've been looking at a stock that was at $215 just 6 months ago, and we were able to buy it at $174 the other day. Now, being in cash allowed us to buy that stock at $174 instead of $215. Now, that is a lot better value. No matter what happens, if the stock turns out to be a bad stock and we lose money, we lose about 20% less. But if it goes up, we make 20% more. So the idea of buying stocks and waiting for the opportunity is not that we're not making any money in the cash. The cash is allowing us to buy it cheaper and get us a return, and sometimes you can get that return in a couple of months because the stock goes down, it recovers, and then it's on its way up. So the important thing is that we use cash as a portfolio tool to be able to wait for those opportunities, and they always come. I've been in this business for 45 years. I've never seen a year where there hasn't been some kind of a shakeout where you can't pick up a stock or a couple of stocks or even 10 stocks cheaper than what it was at the top of the market. So we are using the cash to reduce the risk, to be able to buy at lower prices, and then to create the opportunity. Okay, let's move on to the next section, which is the gold section. Now, because of the long-term potential of inflation, we have decided to use gold as an asset class, and we're going to review that with great length. There have been debates about what the price of gold should be for hundreds of years. I started off in the 70s. We were lucky to be able to get in on gold when it was freely traded the first time, August 15, 1971. And so we were able to make a lot of money. That was the first good hit I made as an investment counselor, and we did real well with gold. But gold was at $40. It's a different price today. And the methodology that we used at that time was, I would say it was more luck than methodology, because gold was so depressed you could almost not help make money. But that's not the way the situation is today. You have to buy gold at the right price, or you could have an asset that's not making you any money for a long time. Now, these disagreements have been going on for many years, and here's the reason. Some people feel that gold is money, and some people feel it's just a commodity. And you can debate this, but let me just show you back into the 1836 with Baron Rothschild. He was the Warren Buffett of that era. And he said there's only two people who truly understand the price of gold. One is a director in the Bank of England. The other one is an obscure clerk in the Bank of France. Unfortunately, they disagree. So that has been the problem with gold for hundreds of years. Now, we decided to use the methodology that we use as value investors to put a price on the price of gold, and I think we found a pretty good methodology that will give us a reasonable entry point. Here's what we did. The first thing we did is we know that gold is traded for 40 years, so the market price works out what it is worth at different price. So what we did is we took gold in 1971 and we inflation adjusted and said, okay, if it was $650 in 1982, what is it worth today? So we took the inflation adjusted approach. Then we took the actual cost of producing. We've talked to gold miners, we've talked to people who do the accounting in gold, and we've read all the reports by the Gold Council. And so what we came up with is we know that whatever the cost of producing gold, which is about $1,100 to $1,200, called the marginal cost of gold, that is the actual cost of producing an ounce of gold. So we use that as a methodology. And then we used a relationship between gold and oil, and there's been an amazing relationship between oil and gold that's held for 70 to 80 years. We used gold versus the CRB metals. That's all the commodities, the metals. We used it against home prices, and we used it against the CPI. And the National Bureau of Economics just did a report where they hired commodity traders and economists, and they tried to figure out what a methodology to use for gold, and they used the CPI. They took gold and divided it, or put the CPI and divided by gold and the ratio, and we have included that in our statistics. And here are the results of the statistics. At the peak, using all those relationships, we're coming up with 1,900 to 2,200. The fair value, about what it should be trading on, is about $11.50 to $13.00. The buy point is about $800 to $1,000. And the worst case, as low as we can conceivably see it, is about $600 to $700. So when it gets into the 800 range, you've got a good price to buy. You never want to pay more than $11.50 to $13.00 because that's basically, you just have a flat line. You wouldn't make much money, but it's certainly worth that. Now let me show you on the inflation charts how we did that. This is only one of 6 methodologies. We don't have the time to go through all of them, and you probably wouldn't want to hear all of them anyway, but we'll go through the first one. This, to me, is a very valid methodology. I've done this with many commodities, including oil, and it's a very good way to do it. In 1982, gold was selling at 3.25, and if we inflation adjust it, it's at 7.15. If we do the 285, the inflation adjusted is about 715. So you look at the bottoms and you can see that 300 is about the bottom, and if you inflation adjust it, it's around 650 to 700. That's our worst case. If you look at the midpoint, the fair value, it's around $509. That's that little peak there in 83, and then we ran that down, and that came out to about 1,200. So the midpoint is about 1,200. And then we inflation adjusted to peak in 1980 at 860 and ran it out. It came out to 2555. We took a more reasonable peak in 1980 at 711. It came out about 1900. So you can see the upside is about 1900 to 2500. The downside is about 600 to 700. Buy point of 800 to 1,000. And we've actually started to invest into gold mining stocks, and that is an anticipation of the prices that we expect, and the purchases are based on this model. So now let's look at the next chart, which is the raw commodities, which is inflation. Now, if you wanted to use one guide to figure out how to hedge yourself against inflation, you could use raw commodities, because raw commodities are always going to reflect the depreciation in the dollar and the increase in the commodities. And if you started that in 71, when the dollar was detached from gold, which is the inflationary period, you go up to the peak, it goes up about 5 times. So in the last 40 years, if you would have bought commodities, they would have gone up 5 times your money. So that would have been a good way of protecting against inflation, and we are in fact using that and are starting to buy some of these companies that have low-cost producer in commodity. Now, to remind you again of why stocks go up more than almost any other class, no matter what goes on, I'm going to give you the reasons. The first thing is, if you invested in commodities, it would go up 5 times. But if you invested in stocks, the chart shows that the commodities are on the bottom. They went up 5 times, but stocks went up 15 times. The Dow went from 1,000 to 15,000, while the CRB index went from 100 to 500. So how do you account for the fact that stocks perform so much better than the raw commodities when the raw commodities are really reflecting inflation? That is always a question that I have thought about, and I can give you the answers. One of the reasons is that raw commodities reflect inflation, and stocks reflect the increase in inflation and the human ingenuity, the technology. And that is so great that when you combine commodities, which stocks own, they own inventory, they own real estate, they own plant and equipment. So stocks have commodities in them, but they also have human ingenuity. And this human ingenuity is so great that when you combine it with the capital and the commodities, you have an increase of 3 to 1 over what the commodities did. And just to give you a couple of examples of that, you've all used Apple and used their products. That was started in a garage by 2 men with an idea. They created 80,000 employees, and Apple people are 600,000 worldwide that are connected with the Apple Corporation, not necessarily working with Apple directly, but indirectly working with Apple. So here you have a guy who created $500 billion of wealth out of nothing but an idea, and use the commodities and the capital to create this kind of wealth. And that is the history and story of America. And then you take Jeff Bezos. He employs 88,000 people, probably has hundreds of thousands of people connected with it, created $142 billion of market cap of wealth out of, again, nothing. There's a Latin expression called ex nihilo, out of nothing. It's the only Latin word I know, but it's one of my favorite. Bill Gates, 100,000 people, $290 billion in market cap, and Mary Kay Ash started Mary Kay Cosmetic on a kitchen table, part-time as a mother, 45,000 in people, $3 billion in sales. This is the reason why proper investment in stocks always yield a greater return than commodities, even though they are showing, even though commodities have a great return, when you combine it with the human ingenuity, that is where you get your bang for your buck, and that's where you want to do it. But I want to caution you, you have to buy stocks at the right price, because if you buy them at the wrong price, just like in the technology bubble, it could go against you and you could lose money. So it's not a guarantee that you're going to, even if you use the best vehicle, that you're going to make money. It's got to be bought in the right price. And I want to give you a couple of examples of that. This is an overvalued market. This is where I started in the business. And this market didn't go anywhere for 16 years because of the fact that it was so overvalued. Now look what happened. During that time, I've drawn a value zone, and if you would have bought stocks in the value zone, and when we started in '74, we did, you can make a lot of money. There were 7 or 8 trading opportunities, 30% each, in a market that really went nowhere. So if you buy the individual stocks, even in an overvalued market, you can make money over the long run if you stick to the discipline by buying in the value zone. Now I'm going to give you another example of a terrible thing that happened. It was one of the worst things that happened to America. It was the bombing of Pearl Harbor in December 7th. Can you imagine anything worse than losing a big part of your fleet, getting dragged into World War II that you weren't prepared for, and having all the dislocations of a major attacks like that? And look what happened to the stock market. The stock market was so cheap that even with this catastrophic event, it dropped 18%, and during the whole war, during the whole 5-year war, even a term when it didn't look like America was doing too well, that market continued to go up and went up an average of 14%. And what is the answer to that? If that would have been an overvalued market, it would have dropped 50%, it would have been down for years. But because it was so cheap, people could buy in there despite all of the problems, and they still made a lot of money. So in closing, I want to say one thing. We have covered the positive trends. We've covered the areas of concern. We're going to show you the investment opportunity in the market today. Our major concern is the Federal Reserve with the inflation situation, and that is something that we have to be very careful of. Now let me show you the final chart, which is my favorite chart. I always show it in every seminar, and it shows you what Americans really do, and you all deserve a hand for this, because this shows you the wealth increase over the last 60 years in America. We have gone from less than $1 trillion in wealth to $74 trillion. We hit a peak before the recession at $69 trillion. We dropped to $55 trillion. And with all the problems going on, with all the problems in the government and the economy, the American people's wealth after debt is at a record high. That is productivity, and that is the ingenuity of America. And if we give the money to the public and let them reinvest it instead of giving it to the government, then we're going to get this kind of results. They're going to create jobs and take care of all the problems that we need to do through jobs. And let me tell you why that is. We can't predict the future, but if we invest with discipline, we create the future. We can figure out a way to make money irrespective of what happens, and by doing that, we create our own future. We can't tax our way out of debt, but we can grow our way out of debt. This means doing what America has always done best. Encourage creativity, innovation, entrepreneurship. Create products and services that are the best in the world. Develop new business that create jobs. And like I said to you before, jobs is the key to everything, and I'm going to show you why now. Jobs help pay the taxes. Jobs help pay for Social Security and social program. Job creates money for consumers so they can grow the economy, and if we grow the economy 1% more, then we are able to take care of our debt. And most important of all, jobs create people who are independent and who have character. And it is what makes the key to creating jobs. Hardworking people willing to invest and take risks. For this reason, and this reason alone, creating jobs is the best social program in the world. Thank you very much. Thank you, brother. Thank you.